Hey everyone, welcome in to another daily editorial here on the KE Report. This is going to be a bit of a different daily editorial as we're going to take a broad look at resource stocks. This mostly deals with smaller cap stocks and the potential that these stocks have. I'm sure when most investors look at them, sometimes 8, 10 times or 10 bag potential for some of these stocks. But as the story develops, that potential dwindles. A lot of it turns into a dilution game and companies that just get a little bit over ahead of their skis and, quite frankly, don't manage the capital markets correctly. This is going to be a very interesting discussion. We are chatting with Dave Erfle, founder and editor of the junior miner Junky. Now, Dave, as I said, a lot of this, I guess, underperformance in terms of overall potential of stocks comes from dilution. Share prices can remain the same. Market caps can go up as companies continue to dilute, but that unfortunately takes away some or a lot of the upside in some of these stocks. So, Dave, as you're analyzing companies and seeing some great potential out there, again, 8 to 10 times potentially from when you first do the research, as the stock progresses a couple of years down the road, that potential dwindles. What's your take on this whole trend, unfortunately?
Oh yeah, I mean, I've seen it in so many companies, and I'm holding a few of them that are in that situation. I mean, you have a company that when you start doing your due diligence, of course, the first thing you look at is management and their track record. You look at the project, you look at the jurisdiction, you look at the share structure, you look at all these things, and they tick most of the boxes. I'm sorry, no company ticks every box. So you're looking at what the company needs to have in place for you to start accumulating shares. You start doing it, and the gold price is cooperating. But if you take a look at what's happened with a lot of these stocks over the past few years, while the gold price has gone sideways and then recently started to go up, the cost associated with de-risking these projects has gone up along with everything else. And just have to make sure that these management teams, they raise money at the right time, not only a large portion of capital and where the capital comes from, but the timing of the capital and what they have to sacrifice to attract that capital. For example, of earlier this year, you had a lot of these companies come into the year and they needed money, but it looks like the gold price was cooperating, so they were going to wait a little while. They figured the finance window was going to open. They could wait and get that capital later when their share price was higher. That didn't happen. A lot of these share prices went lower after tax loss season. We had a little pop the first few weeks of the year, but then they started going south again. So these companies were stuck in a situation where they had to raise money, and the street gets wind of this information. They know they have to raise money. They start shorting their stock, and they wait for the announcement for the raise. They know it's going to be a warrant, so they short the stock. They get it lower. They can get in at a really good price, and then they can strip the warrant after holding the shares for only 4 months. That's happened with a lot of these companies, and all of a sudden, your stock that you thought had 7, 8, 9, 10 bagger potential now it only has maybe 2 or 3 bagger potential. So this is happening a lot in a lot of companies, and it's still happening right now, even with the gold price around $2,400 an ounce.
Dave, I find this to be a fascinating topic because it's happened to all of us. Everybody listening to this call has companies where you started off with an initial due diligence and you were excited about the upside, and over time, things changed. And even serially successful management teams that have maybe sold 2 or 3 prior projects have struggled in this last cycle. It's been particularly brutal. Do you think a lot of them are using the playbook from a bull market of times past where you go out, you raise money, you drill again, you have success, you build resources, and then somebody takes you out for a premium? But what we saw this cycle was you go out and raise money, you drill, and even if you have good results, your share price sells down. So you raise more money, more dilution, you drill again, your share price drops even further, and nobody's buying you out. And even if you're building resources and doing good work and you're delivering on your promises, your share price has still gone down. So now to the point where they've diluted down their projects almost across the whole industry to the point where it's hard to get any upside momentum. Is it just different because of how brutal this last bear market just was?
Absolutely. It's a different market now this time around. Capital's no longer cheap. When these financing windows do open, like the financing window was opened again recently, a little wider, not everything is getting financed. And as though we are starting to see more company favorable financings. But yes, I mean, a lot of these management teams, like you said, during the last bull market, they would raise money, drill, get good results, the share price would go up, and they'd be able to raise more money at a higher price. But this is a different market now. And a lot of these companies have not adapted to it and they've been burned by it. You've even had several companies, by missing the capital market window because they owned a large chunk of shares themselves and they didn't want to over dilute themselves. They waited too long, and then some of them had to end up selling their best assets for peanuts just to get funding to keep going to fund their other projects. So yeah, this is a totally different market now than past bull markets.
But Dave, how do you go about analyzing some of these stocks then? Because in all fairness, all of these companies need to raise money unless they're already mining, but then sometimes that is already too late for the 8 to 10 bagger potential. So we are talking more about kind of earlier stage companies here that seem to have that they're onto something. There is potential here, but they are going to have to keep on financing. So what do you want to see these companies do that keeps you engaged as a shareholder?
You want to see that they have that access to capital. Do they have a strategic partner? And if they're farther along in their, like I told you, I've been telling you several times over the past several months, I'm not interested in early stage companies anymore. So I'm looking at later stage companies. So if you're looking at later stage companies and they've proved up these assets, they have multi-millions of ounces. Do they have that strategic partner? And also another important thing is permitting. They might have that strategic partner, but if they're in an area, if they're in a top tier jurisdiction like Ontario that takes a long time to get permitting, it might be 3-4 years down the line before they get their final permits to be shovel ready, even though they've already come up with a feasibility stage. So that's pretty much dead money for a while, and the market's not going to touch a stock like that. So you have to look at permitting, you have to look at access to capital, you have to look at past raises. What did they have to sacrifice to get that money? Did they have to give a full warrant? Are those warrants still outstanding? How many are out? Are they going to cap the share price once it gets around there, around that warrant price? Sure, it's going to bring in money, but it's also going to cap the price a bit. I mean, you have to look at all these things before you get into these stocks, no matter how attractive the asset looks or no matter how attractive the stock looks.
Dave, a lot of these companies in the bear market we had the last 3 to 4 years basically had to survive. And so they had to pick which poison they wanted to drink. And if they drank the poison of dilution at the equity level, people would be very upset that, hey, now you're diluting down the share count, you're blowing out your shares, and you're raising again at lower and lower levels. So a lot of management teams said, well, what else can we do? Some have forward sold royalties. Some have brought in that strategic partner, but they are diluting still just at the project level, which means they don't own as much of their own project anymore. There's other companies that brag, hey, we've got 100% ownership of this project, but they sold other projects that were also core and suddenly became non-core to survive out of all of those. Which poison pill to drink do you think is the best option for companies, or which one do you like to avoid if you see it in a company?
If a company has to, if a company needs money and the market knows they need money and they have to give a full 3 or 4 year warrant along with the finance at a below market price, that is not a good sign at all. But recently, we've had some attractive financings. Faraday Copper is a good example recently. They did a 20 million bought deal at market without a warrant, and the share price went up. That's a positive dilution. That's positive financing. So you want to look at what did the stock do when the last time the company had to raise money, what did the stock do? What was the market's reaction? Look at the volume. Look at if the finance was below market. Did it have a half warrant or a full warrant? How many years out are the warrants? Who was involved in the financing? Did the management participate in the financing? Did strong hands participate in the financing? So you look at all these things, and if you're satisfied with who participated in the finance, it was at a decent price. Sure, the company had to dilute, but it was more positive for the company than it was for the bankers. Then that's a good sign.
Yeah, the who was in that financing. Faraday's a great example of that. It was actually announced as a premium to market, shares only, no warrant. They have the backings of the Lundins. They also have Pierre Lassonde as a shareholder. So that's kind of the perfect scenario right there when you have strong hands that continue to support a stock. But it also comes as to what work are they doing on the back end of that when they raise that money, and when are they going to raise again? So right now, Dave, when you see companies raise money, even when companies have money, how aggressive do you like to see them with their work programs when it comes simply to budget, spending that money?
Yeah, you want to see that money going towards something that's going to be positive for the share price when they're done with it. If it's an infill program to get to a PFS, or if it's a step out program and something they're trying to get bigger, whatever it is, what's going to be the result? Because it looks like to me both gold and silver prices are going to be higher once their work program is done. But will the market reward them for it? Meaning, okay, they've done all this great work, they've made the project bigger, or they've de-risked it economically. What's their permitting timeline? I mean, so once it's finished, they've got a PFS out. When does it look like they're going to get their environmental permit? Because once you get that environmental permit, that everything falls into place after that, pretty much in a lot of these jurisdictions. Permitting is a big one now. It's funny because during the last bull market, I mean, I don't even remember having to do that much due diligence on permitting. From the 2009 2011 bull market, nobody really talked about it that much. And it was all about ounces in the ground. How many ounces did they have? How many ounces are they going to prove up? How many ounces do they need? And things like that for their project. So it's a totally different market now, and you have to look at different things. And permitting is a big one.
Dave, just on the topic of what used to be multi-baggers, maybe 5 baggers, 7 baggers, 10 baggers, turning into 2 and 3 baggers, when you look at companies and look at their share prices over long-term charts, it's a lot different picture than you may get on a short duration chart, but it's also a lot different company. If you go back to a lot of these companies over the last, let's say, 5 to 10 years, they don't look anything like the same kind of company that they were 5 to 10 years ago. They've built new mines. Some mines have become depleted. They've acquired projects. They've sold projects. Some of these mid-tier producers all the way down to small producers and even development companies may have had 5 projects in their fold. Now they've got 3. And then there's the other group of companies that are single asset companies. And when you look at the share charts of both, they both dropped the same. But one company has done things internally to build value or swap around projects, and the other company is a single asset company with only one thing bobbing and weaving in the market. Do you look at those scenarios different if both their charts are down the same, but one has built value through acquisitions or growth or development, and the other just has the same project they've always had? Do you look at those differently?
Yes, I mean you have to, and it all depends on the jurisdictions they're in. Also, the one company could be in a jurisdiction where the permitting timeline is shorter, and it looks like they're gonna be shovel ready a lot sooner than the other one. I'm sure the other one that hasn't performed well could be in a great jurisdiction, but it could be in a great jurisdiction where it takes a long time to get that environmental permit. And a lot of times you look at these stock prices, like you said, they're totally different companies. I mean, they could have started off with their flagship asset was a certain asset, and maybe they acquired something that was better, and now that flagship asset has become an asset they want to monetize, and now they're de-risking this other asset that's now their flagship asset. And also there's all that dilution that went into that share price while they're doing it. Yeah, you bring up a 6-month chart of something and you look at it and you go, wow, this stock's doing really well. It bottomed with the sector in March right before the gold breakout, and it's doubled or tripled. But then you take a look at a 4-year chart, and it was maybe $5 or $6 back in 2020, and now it's 50 cents. You definitely have to look at the big picture on these things. You set up these Zoom calls with these management teams and ask them the tough questions. And you basically have to make sure that you get into the right ones at the right time. Timing is everything, especially in the junior sector. And a big one is there's a couple of stocks that I've gone through this with, a few of them that I've held on to for several years. Some of them are doing really well now because they're cashed up. They're cashed up to a construction decision. That's a term that you want to see. If you're cashed up to a construction decision and you've got that permitting timeline where it looks like they're going to get their environmental permit right around the time they're going to make that construction decision, that's a really big positive. So you look at things like that before you get into something. If they're permitted to construction, that's a huge one.
Isn't the problem, though, Dave, that it's not that we have too many stocks. We do have too many stocks, but we also have too many old stocks, too many recycled projects, not enough new stories out there because, quite frankly, it is the new stories or the rework of something that is new for the market that has this sort of huge potential. Stocks that have been around for 5, maybe even 10 years, their 10 bagger potential, unless they've done a major rollback and usually change strategy, that potential just isn't there.
Right. Absolutely. And that's my modus operandi in doing this for myself and my subscribers is I don't touch anything unless it has at least 3 to 10 times upside potential. And a lot of these companies that I got into that had that 10 times upside potential now maybe have 2 or 3 times potential. I'm not going to sell them because if I'm down on them a little bit or a lot, I'm not going to sell them because I know that potential is still there. It's just not as much as it was. And I still have other stocks that do have that 10 times upside potential that'll cover some of the other ones that maybe don't.
Well, Dave, this brings up a really interesting point as far as portfolio management, because there's different schools of thought, different strategies that work for different types of investors. But there's some people that would like to take a basket of early stage companies, hoping that a few of them are 10 baggers and that those bail out the ones that are more likely going to be a failure because a lot of drill plays don't work out. But then you could take a more conservative approach and buy companies that are 2 and 3 baggers that have more proof in the pudding, but maybe not as much upside. What's the balance that I mean, I know it's different for everybody, but when you look at it, striking the balance between swinging for the fences but with high risk versus taking a more conservative bet, because a 300% gain is still a really nice gain. A 3 bagger shouldn't be just shrugged off because it's not a 10 bagger. So how do you balance the risk versus the reward in those kind of scenarios?
Yeah, I mean, that's the thing, right? As far as early stage companies, I don't even mess with them anymore. I mean, it's sure there's a few of them that have done really well, but the risk reward is just not there anymore in this market. So I take that strategy now with developers and with developer explorers. Let's say you take a position. I don't put any more than 5% of my investment capital into one company because I don't care how good it looks. Something bad can go wrong. Let's say you get 20 of them, and all it takes is for 2 or 3 or 4 of them to do really well, and it's going to cover the ones that you got into that don't do so well that you end up maybe losing money on. So that's a great strategy to have right now, and that's what I'm doing, and that's what I have been doing for myself and my subscribers.
What about market cap wise? Is there a general range of market caps that you see as companies at least having something, but still have that upside potential that you're looking for of that multi-bagger potential?
Yes, I still like the market caps that are less than $1 billion because especially if they have a tight share structure, because I see that as companies as having more upside if they're in the late stage development and they got blue sky potential and they've proved up a lot of ounces. They got a long life mine here, it looks like, and they got the access to capital and they got a seriously successful management team. They've done a good job de-risking it so far. You look at something like that, and there's fewer stories out there than you would think that ticks all those boxes. But yeah, I mean, that's what I'm looking for now. That's what I'm holding right now, mostly in my portfolio is companies like that. I see that potential. Some of them still need that strategic partner, and some of them recently got a strategic partner. Some of them have a few more years before they're going to be shovel ready, and those stocks are lagging a bit. But I see them as maybe potential takeover targets because they had this huge land package. They've proved up all these ounces, and they're in this great area. And I know there's majors around there that are looking for ounces, and they're going to eventually have to acquire them. So you have to be really patient, and you have to make sure that management has that access to capital while you're being patient, and they raise money at the right time, and they're able to raise it without having to offer a warrant to get it, or if they do have to offer a warrant, just maybe a half warrant, and you could still hold on for a while. But it's really tricky right now. I mean, it's funny, you take a look at the gold price and it's doing really well. And especially after we had that major breakout above 2,100, and now the silver price above $30 to join the gold price. Yet a lot of these junior stocks, you still have to turn them upside down for them to look like the gold chart.
Dave, just one more on the share structure and the market cap and dilution. So if you think about a company that diluted down and blew out their share count by acquiring other companies, and so they've added more projects, they've added more ounces in the ground, maybe they've added a producing mine, or maybe they've added a development project or a string of exploration projects. That's a different kind of diluted down share count than a single asset company that's diluted down all in the same project and they're still not getting traction. When I was asking that question earlier, that's kind of what I was getting at. Would you look at it differently if a company has diluted out their share count, but it's because they've doubled the amount or tripled the amount of ounces in the ground, or they've doubled the amount of pipeline of development projects that could move into production? Would you view that kind of dilution as possibly having more optionality when the prices do rise versus a company that's diluted down the same project over and over again and they've never gotten love for it?
Yes, if they've acquired an asset that is close to being shovel ready, and if their permitting timeline looks credible, hey, 1 or 2 years they're going to get that permit, then that'll line up to where they'll have a bankable feasibility study. It's a high margin project. It looks like it's probably going to have a low initial capex, and they raised money at the same time that they did this merger, so they have some cash. Do they have a strategic partner to get more money when they need it? You have to look at all these things. I mean, sure. I mean, if you see a company acquire another project, it's a merger and it's an all share deal and it's dilution. Does that merger make sense? I mean, we were talking off mic about mergers that did make sense and mergers that really didn't make sense. And if you see a project that has all these problems associated with a project that needs to be financed, and they got to raise initial capex that's 3, 4, 5 times their market cap, but they acquire a project that needs exactly the same thing, that doesn't make any sense. And we've seen that happen a couple times with a couple of these companies, where they just merge with other companies that have the same problems they do. So you want to see them merge with a company that has that access to capital that's going to solve those problems that they have to get this project built.
Well, a lot to take in here, Dave. Fact of the matter is, look, dilution can kill these stocks, but it's also needed to move companies forward too. When you get into any sort of a company, a stock, yes, you have your game plan, you see what the potential is, but you need to keep on analyzing that and not just fall in love with the story, because stories change and sometimes they go a lot slower than what you anticipate. And unfortunately, that is not just the time value of money there. It is also the fact that these companies can get in a lot of trouble at just burning through cash. It's what we've seen in a number of companies, and we're still in that market through dilution and a lot of financings, especially recently. I hope you all listening got something out of this conversation. I hope you all found it interesting. We're happy to rehash some of these topics with Dave in future conversations. Just let us know what you want us to talk to Dave about, and we're happy to bring that up. Dave, thank you as always for your time. It's always great chatting with you.
Thanks, guys.